Hello everyone, welcome to Wealthy and Healthy. My name is Emma. In the last video, we've talked about TFSA and RRSP, and we've mentioned you cannot hold RRSP forever. Instead, you'd have to convert it into a RIF account when you turn 71 years old. Today, we're going to have a look what is a RIF and what are the benefits and the rules around it. RIF, just like an RRSP, it is a registered investment account. We have talked about what is a registered investment account in the RRSP video. For those who have missed it, you can find the link to it in the description. Since RIF is a Canadian investment account, the content today is only applicable to Canadian residents. Let's look at what is RIF. RIF stands for Retirement Income Funds, and just as the name suggests, this will be one of your income sources after you retire. It is an extension of an RRSP. The year you turn 71 years old, you will have to convert your RRSP to a RIF. This conversion does not trigger any tax payable, as you are just transferring your investment from one tax-sheltered account to another, rather than withdrawing them. After the conversion, the CRA specifies you must take a minimum amount out of your RIF account every year and pay applicable income tax on the withdrawal. How RRSP and RIF differs, one major difference between them is that you can add investment to RRSP up to age 71. You cannot add investment to a RIF once it's established. If you look at the difference in terms of their functions, an RRSP is a tax-sheltered account you use to invest for your retirement, while a RIF is a tax-sheltered account you use to withdraw income for your retirement. Since you withdraw money from your RIF for retirement, let's have a look at the withdrawal rules around it. As we mentioned earlier, RIF account holders will have to take a minimum withdrawal from their account every year, and the withdrawals are taxable income. You can choose to receive this amount as an annual lump sum or monthly. You just need to tell your bank or broker how you want it. The minimum withdrawal amount is based on your age or your spouse's age, and the value of the entire RIF account at the previous year's end. We will have a look at the age and the withdrawal percentage table on the next slide, and I promise this will make more sense once you see the table. If you choose to convert your RRSP to RIF at age 64, you would have to take out a minimum of 4% of your entire RIF account value when you turn 65, 4.17% for 66, 5% for 70, on and on. As you can see, the minimum withdrawal percentage increases as you age and will reach the highest 20% once you reach 95 years old. Since the withdrawal amount can use either your own age or your spouse's age, that gives you some flexibility. If you already have other sources of income, you do not need much from your RIF account. You could use your spouse's age to calculate the minimum withdrawal if your spouse is younger. Using their age will result in a lower minimum withdrawal, allowing more of your investment to grow in a tax-deferred environment. Now that we know withdrawals from RIF is taxable, let's have a look at how the tax works. When you just take the minimum required withdrawal from RIF, you do not need to pay withholding tax upfront. Your withdrawal amount is the actual amount you receive. You just need to include this amount as your income when you file your tax. If you withdraw more than the minimum required amount, any funds withdrawn in excess of your minimum are subject to withholding tax, and the withholding tax rate differs when you withdraw different amounts. We have talked about what is withholding tax in the RRSP video. Withholding tax is the CRA retained tax on your withdrawal, but this is not the final tax amount you would have to pay. It's similar to your paycheck. When you received your payroll deposit from employer, you would see the tax has been deducted already, even before it hits your account. And then, when you file your tax for the year, that's when the CRA finalizes your tax liability, and you may have a tax refund or amount owing, depends on your overall income and deductible expenses. The following chart shows the withholding rates for RIFs annualized withdrawals in excess of minimum amount. If the excess amount is below $5,000, the withholding tax rate is 10%, 15% for $5,000 to $15,000, and the highest is 30% for more than $15,000. It always helps to see some examples. First one, if Sarah only withdraws the minimum required amount from her RIF this year, no withholding tax applies on withdrawals. She just needs to claim that RIF withdrawal amount on her income when she files tax for this year and may or may not have a tax owing, depends on her overall income. Second situation, in addition to her minimum withdrawal, if Sarah wants to withdraw $4,000 more for the year, or $333 per month, Sarah will be charged a withholding tax of 10% on the $4,000. $4,000 minus 10% of $4,000, which is $400. $4,000 minus $400 comes to $3,600. So she will receive a lump sum of $3,600 or $300 every month. And she needs to claim that RIF withdrawal amount, the minimum plus the $4,000 on her income when she files tax for this year, and may have a tax refund or tax owing, depends on her overall income. That's a simple introduction to a RIF account. Now that I don't want you to have a wrong impression that you can only have either RRSP or RIF at one point in time. You could have them both at the same time if you want. Just convert partial of your RRSP to RIF before 71 years old. You would end up having them both at the same time. And there is some tax benefit to convert partial of your RRSP holdings to RIF and receive payments from it. Also, as we mentioned before, you could set up beneficiaries for your registered accounts. For RIF accounts specifically, you have the option to set up beneficiaries or set up your spouse as the successor. In the event of your passing, if you have your spouse as the successor, the RIF account will be moved to your spouse's name, and he or she will continue to receive the annual payments from it without having to pay a huge upfront income tax as you would if it went to your estate or other beneficiaries. We will talk about this more in depth in future videos. If you find this video helpful, please give me a thumbs up. If you want to see more videos like this, subscribe to the channel. And turn on the notification so you don't miss the next one coming up. I'll see you next time.